for that, because I think the whole bond market is going to be selling off in Europe and the U.S. in response to that UK inflation, and that front end just getting hit the hardest, Danny.
Yeah, look, we've unfortunately learned over the past year or so that the UK bond market can do pretty wild things, and those wild things have global ramifications. This is a global bond market. Alex, I wanted to show you exactly what CPI looks like in the UK. It's the white line I have on my chart. Europe is in the blue, US is in the yellow. Now, since COVID and this big pickup we've seen globally in inflation, it really has been the UK. It's the second highest inflation reading in the G10 space. It's at 10.1%. That is the reading we got this number. The expectation was still high. It was 9.8%, but now we have the psychological still double-digit number to contend with. Alex, part of the issue is that the highest thing in here, one of the biggest gainers in inflation, was food. Some 18% is where prices jumped in the last reading. Is that really something that can be solved with higher rates? Is that really a demand problem? Because, hey, people are always going to want to eat. So just what exactly can Andrew Bailey do to get UK inflation down?
Yeah, it's not even that. It's also the surprise that it happened like that. Berenberg senior economist Callum Pickering joined Bloomberg Television to talk about that surprisingly sticky inflation and then what the BOE is going to be thinking about it.
The Bank of England will be, relative to its February estimate, surprised by what Q1 inflation has done. No question, and therefore that supports the hike again in May. But the balance of demand and supply is pointing towards disinflation over the course of this year. You have big energy base effects to wash out. Monetary policy is not by now tight. Fiscal policy is by now tight. Producer prices have turned down a lot.
So all of this brings us to our question of the day. Does UK inflation 10.1%, does it push the BOE to 5%? Is that where rates will peak, or does it go perhaps even higher? Joining us now to help answer that question is Christine Aquino, managing editor of Bloomberg Markets, and MLive editor Van Ram. So Ben, what say you, 5% BOE?
5%, possibly even more than that, even though the economy is kind of feeling the shocks of the slowdown that we've long doubted to have had. But, you know, if you look at the 5-year real rate in the UK, it's just 7 basis points. That needs to push up to 100 basis points for the BOE's tightening to have any meaningful effect on inflation. Clearly, what we saw this morning is not enough, and the BOE has acted too late, and now too late and too emphatically, and they need to go higher from here.
Yikes. 5 or more. Okay, Christine, talk to me about a 5 or more for the markets. How does that re-rate?
Yeah, that's going to be interesting, Alex. I mean, what Danny was alluding to, though, is a big question when it comes to getting actual inflation under control. Because, again, what we're seeing is signs of supply-driven inflation rather than demand-driven inflation. And so the question really is, what is the 5% rate going to do to bring that down? Probably not a lot. When it comes to markets, I think it's going to be a very interesting journey for the pound in particular. I mean, today we saw kind of a microcosm of the confusion over whether this is good news or bad news for the pound. We've seen that whipsaw a lot today. I mean, on the one hand, higher rates does mean positive things for the pound. It makes it more appealing to investors internationally. But then there's also the danger that higher rates leads to a buckling consumer. And that has been, up to this point in time, a big driver of UK resilience. But if that story will start to crumble, obviously that's going to mean bad things for the pound down the road.
Yeah, it was a story we talked about a lot at the start of this rate hiking cycle, the sensitivity of UK consumers because of floating rate mortgages. Is that still true, that there's a limit to what Andrew Bailey can do just because of how directly it hits consumers?
Absolutely, Danny. I mean, that is one of the danger zones that the Bank of England was watching out for when it comes to the impact of higher rates. And we haven't even seen that come through to fruition. I think the bulk of those mortgages that are due to refinance, that's not going to come until September time. And so the second half of 2023 going to be particularly challenging for the UK on a number of fronts, especially if we don't see that impact of inflation on inflation from rate hikes potentially next month and maybe even in June from Bank of England.
So Ben, if we go to 5 or above, how is that going to help like my price of beans? Like I understand the idea, right? Okay, so things are going to go up, so I'm going to not spend on other stuff like clothes, and that's going to help me buy the food. But in theory, are we just past that now? Does this have to be a government thing?
Well, I think that they've got to clamp down on second round demand effects, and that's where the BOE's tightening is going to help. Yes, it would have helped a lot. It would have helped a lot had they been emphatical in their rate increases. For instance, the first 50 basis point rate increase from the Bank of England came only in August last year, by which time inflation was already in double digits. Now they are having to play catch up, and that requires shock and awe.
How much of this can you extrapolate to other G10 nations with sticky UK inflation and the need to keep hiking?
Well, I think that the ECB and the Fed are in much better situations. We have seen the ECB's Eurozone inflation rate come below 7% and around 5% in the US. So the Fed has seen that its tightening has so far delivered 400 basis points of contraction in inflation. We haven't seen that in the UK, and definitely there's a lot more response in the EU as well. So I think that the Fed and the ECB are much better placed than the BOE.
That's just so interesting because I feel like that conversation has rapidly changed, like just in the last few weeks, Christine. I feel like it was, the ECB is going to be the hawkish one, the BOE is kind of done, and then the Fed is one more and done. And I'm just wondering how unprepared positioning is for a situation where that's just flipped on its head.
Yeah, I mean, that is the question, isn't it, Alex? And I think even just the price action today, where we're seeing the sudden adjustment to expect more from the Bank of England, just shows you how markets have really been unprepared. I mean, part of that, of course, is, I suppose, still some in the market holding on to this idea of a soft landing or a no landing scenario. But I think part of that is also because of the guidance that markets have received from the Bank of England itself. I mean, you mentioned earlier, and I think Danny has as well, that what we've really heard from Andrew Bailey and his colleagues over the last couple of months is that they are nearing the end of their rate hiking cycle. And time again, they've been surprised by an upside shock to inflation that's staying in the double digits. And I think that's kind of just put them in a difficult position now.
Yeah, and I guess, is it maybe a cautionary tale for other central bankers who are also talking about the end of their cycle? Really interesting. Thank you both so much for joining. That is Ben Ram and Christine Aquino. Now, coming up, we're going to get more insight on our question of the day. Does UK inflation push the BOE to 5%? Kieran Ganesh, multi-asset strategist at UBS, is going to join us next. This is Bloomberg.
if these central banks keep pushing against the sticky services inflation to get it back down to 2%, then something else will break. And if that's the case, then we are likely to see more safe haven demand for the dollar too. So I don't really believe that the dollar can really weaken significantly. Certainly, I think it's going to be choppy. There's going to be bouts and risk appetite appears better. But I think we're in for perhaps a rocky ride still for the rest of this year.
Jane Foley there, Rabobank head of FX strategy, talking about dollar strength earlier today. Dollar strength was so much at one point it was exceeding sterling. It was stronger versus the pound despite hot UK inflation. That has turned around though. Cable is up about 0.1%. And all of that gets us to our question of the day and what's fueling a stronger pound. Does the UK inflation figure 10.1% push the BOE to 5%? Let's bring in Kieran Ganesh, multi-asset strategist at UBS. Kieran, what do you think? 5% terminal rate for the BOE?
Well, I think the short answer is no. I don't think it should be surprising that UK inflation is higher than other places. Remember, the Bank of England was quite late in terms of getting aggressive in its rate hiking cycle. And the UK also has a very curious thing with the way it sets energy prices, which means that it's a bit more lumpy than you see in other regions. So inflation is too high in the UK. The Bank of England will have to hike more. But by the time they get towards that 5% level, we think that inflation will be substantially lower. And then they'll be entering more of that wait and see mode that perhaps the Fed is going to be entering a little bit sooner.
So what's higher? 5% more?
Well, 25 basis points at the next meeting, I think, is almost certain. I think now the question is, what do they do after that? The bar for further rate increases has clearly dropped because we've seen this very elevated inflation print. But we think that once they get above 4.5%, then the chances are that they'll start to slow. So we're looking for them to stop in that 4.5 to 5% range.
Does that mean you maybe wouldn't want to participate in some of the sell-off we've seen in the gilt market?
Yeah, so I think in the bond markets, we're seeing them as generally attractive relative to equities right now because, of course, those should rally quite substantially if we do see a slowdown either in inflation or in growth. So we like bond markets quite generally. And where the opportunity we think is actually in positioning in the currency relative to the US dollar, because a trend we are seeing opening up is this idea that the Fed is probably going to be pausing or even cutting rates sooner than other central banks.
Karen, to that point, if we wind up getting another 25 basis point hike and then nothing more from the BOE, the hurdle to cut, I would think, is extraordinarily high, which would go to support your thesis a bit, yes?
Yeah, I think that's right. I think we'd have to assume that the European central banks, including the ECB and the Bank of England, are more likely to hold rates high for longer, whereas with the Fed, where you're perhaps more likely to enter perhaps even a recession later this year, then they could be looking at cutting sooner. So that positioning of being longer in the European currencies and shorter in the US dollar, we think makes sense at this time.
To the point of liking bonds and sort of the trade, if it is, we are in an environment where things need to be cut, there's a lot of sentiment out there that agrees with you. Bank of America's latest fund manager survey had a record number of folks saying they want to be short equities versus bonds, or allocation away from equities and into bonds. But equities continue to defy gravity. What do you make of that?
Well, maybe people are answering surveys in a certain way and doing something different with their with the green button. I think we're seeing clearly a lot of strength in equities, and we think at this time they're basically pricing in a soft landing. We don't normally see US equities trading above 18 times PE unless we're seeing sort of double-digit earnings growth expectations or very low bond yields. So we think it is something of an outlier at the moment. So we're recommending that investors diversify away from US equities, either towards other equity markets like an EM, which is cheaper and maybe exposed to other cycles, or towards some of that high-quality fixed income, which we think is a good portfolio hedge right now.
Well, if the Fed's going to be the first central bank to cut, though, why not own U.S. equities?
Well, I think the appeal is clearly if you see the Fed cutting, then is it going to be good for some of those growth stocks, those tech names? But when you look at the valuations that they're trading at now, it's already pricing in quite a substantial cut in interest rates and earnings remaining robust. We're just not convinced that those valuations are fair, or that those earnings aren't going to see some negative surprises, as some of these businesses will prove to be more cyclical than I think is widely perceived.
Anywhere in the equity market you would buy? Anything you do like in American equity? I know you're looking more at EM, but what about sector specific?
Yeah, so within the US, I think things like utilities, things like industrials, which are actually a bit less cyclical than is commonly perceived. These are exposed to that spending from the Inflation Reduction Act, so we think that those are going to be both secular, strong winners over the coming years, as well as relatively defensive plays in the near term, as well as things like consumer staples, a classic defensive if we are going to enter a slowdown, if the consumer is running low on funds, and things like consumer staples should outperform the rest of the market.
Just going back to your point on the BOE and the ECB, that they're going to have to keep rates higher for longer versus the Fed. What kind of economic backdrop then, and what kind of inflation, or maybe a structurally higher inflation level, would that imply?
Yeah, well, so I think inflation is going to take time to get back below 3%. So we're looking for the end of the year to be inflation to be above 3 but lower. So we think that's the environment they're going to be facing. I think both the Bank of England and the ECB are not going to be comfortable cutting interest rates until inflation is really falling below 3% or declining quite quickly. So I think that's the kind of backdrop we're looking for. It's not that inflation needs to be very high for a long time, but just the bar for cutting rates, as you said, is quite high.
One of the arguments I saw from Bob Elliott on Twitter basically saying that, just looking at the UK specifically and arguing against this idea that they will need to cut at some point or they're not going to get all the way to 5, is just the BOE is in between right now. Just quickly here, I wonder what you make of that point, that they just haven't gone far enough. They've stalled the economy, but they haven't meaningfully slowed it down.
Well, I think all of this is a function of the fact that they started getting aggressive quite late in the cycle. Remember, the BOE towards the end of last year was very conservative in terms of hiking interest rates and then has had to try and play catch up. And now they probably are in this situation where they're a little bit worried that maybe there's some things lurking in the economy, a bit like the Fed had, because they've had to hike interest rates so quickly. So they are a little bit stuck, but they'll just have to look at the incoming data and see how it evolves. As I said, I think a hike at the next meeting is highly likely. In future meetings, I think they're going to be a bit more 50-50 as to whether they hike further, and it will really depend a lot on the incoming data.
Yeah, so I mean, something was already lurking in the economy, right? It was UK pensions last time around. So yeah, I guess that threat is ever real and present here in the UK. Kieran, thank you so much for joining us. That's Kieran Ganesh, UBS multi-asset strategist. Coming up, are you planning your summer holiday? Expect to see airfares in Europe rise by double digit. That is painful. We're going to hear from Ryanair CEO Michael O'Leary next. This is Bloomberg.
I think the positive is demand remains strong, and when we look at high oil prices, we've seen that before in the industry. Inflation, we've seen that before. If you've been around long enough, these are business as usual challenges, and it's clearly a much better environment than it was over the past 3 years.